I mean, I just suddenly thought, goodness me, this 10 ounce coin here. I mean, when it's $100, there's $1,000 there. When it's $200, it's $2,000. I mean, goodness me, I mean, guys, if you're not stacking, I mean, you'd be crazy not to be stacking at these prices.
It's absolutely fascinating, Andrew, what's happening with the gold and the ruble and the petro and all of these dynamics happening here in the gold market. But this episode wouldn't be complete if we didn't talk about one of my favorite topics. I know we got a lot of silver fans out there, so maybe we can just end here with tell us about silver. What's happening in the last couple of weeks here?
Yeah, it just made me think about silver here. I mean, I just suddenly thought, goodness me, this 10 ounce coin here. I mean, when it's $100, there's $1,000 there. When it's $200, it's $2,000. I mean, goodness me, I mean, guys, if you're not stacking, I mean, you'd be crazy not to be stacking at these prices. But yeah, to answer your question, Shane, very short term, we once again have really. We've got COMEX options expiry next Tuesday, and then we got BIS options expiry following that next Friday, the 29th. So, of course, we should expect some opportunities to stack while both gold and silver still have sizable paper element to their offer price, which is the key thing. Now, with silver, the very large over-the-counter short silver futures position related to SLV is once again being defended this week. Clearly, you can see it. However, liquidity providers report that these naked short derivative bets are increasingly being called in by the lessors concerned, that they're not going to receive their metal back as the gold price rises. What it's doing is expanding the ratio trade to unsustainable levels, and then in itself inviting in arbitrageurs, knowing that 80 to 1, 90 to 1, 100 to 1 is just not plausible. And if you're going to continue to cap silver below into a rising gold price, that's exactly what you're going to have to do. Well, that's ludicrous. It's not going to happen. And what we drew attention to in our last episode with the break point for these derivative bets, the capitulation point being at 26,225, a rising gold price will force a breach of this Rubicon line, forcing very, very large short covering. That is the break point for these OCC bets, which are continuously rolled over every 14 days and are not reported. And with that in mind, it's always suspicious. Wake up this morning to evidence an out of the blue CME silver futures margin reduction, specifically following the hard test of this 26,225 Rubicon line. Now, whereas the daily silver futures action, really, it's been essentially sideways. So, okay, why are you suddenly reducing the margins if it's basically sideways? Well, as of today, which is Wednesday, we're recording this, the CME cutting maintenance margins by a full $1,000 to $8,500 for each contract ahead of next Tuesday's options expiry smacks of a sanctioned bailout to me. Expanding the margin position on these very large underwater bets has bought a little time, but it's coiling the silver market for a very large rally as it's dragged up by rising physical driven gold price. They cannot stop that. This will breach the 26,225 Rubicon line and close the 2012 gap to $35. And looking at the option structure really short term for next Tuesday, it's clear while this gaming occurred this week. It's so obvious. There's little need to close gold futures below 1950 next Tuesday. I have a tough time doing that. And there is little need to close silver futures below 25.5, which is again ludicrous that it should be at that lower price. Now, the derivative capping is very short term, and it's coiling both gold and silver for a very, very large catch-up rally. It's not just my opinion. This is the opinion of all the liquidity providers. Now, however, as we reaffirmed with our liquidity providers late last night, official intervention efforts selling paper gold to cap a rising physical gold price into extremely tight supply is wholly dependent on how much hot money, open interest, i.e., the chips they hold in their hand, can be flushed before the EFPs are capitalized on. This hot money open interest begins to exhaust itself below 1950. Beyond this, paper shorts get called for delivery. So there's where we end up on the short term.
Hey, Andy, you showed me your coin. Check this out right here. Isn't that something?
Very nice. And tell me a little bit about it there, Shane.
Well, this is actually from the year of the dog. I've got a white wolf, and so we thought it looked really nice. I thought I like the coin, and it's got the Queen's picture here on the back. But I'm pretty sure, Andy, if I took the paper equivalent amount and threw it at someone, I don't think I'm going to do any damage. But if I ever threw this at anyone, this is going to hurt. This is real money. This is what I love.
Well done. Because to be honest, I mean, when you think how little that actually costs at this point in time versus what it is really worth, I mean, it's mind blowing. It boggles my mind that people are not out buying every ounce of silver they can possibly get.